Good morning and welcome this morning to Trading Futures. Ben Watson here with you. I've got a little bit of a camera issue, so I'm going to keep it on the static picture. But thanks for joining us today. We're going to talk a little bit about what's going on in the futures market this morning. I'm joined out there in the chat by my good friend Connie Hill, and she's a 20-plus year veteran of the financial market. She's there to help answer your questions. Thanks to all of you for being here with me this morning, and thanks to our great production staff for helping to bring this webcast to you. Participate in the conversation. That's what it's there for. Leave some messages in the chat, ask some questions. If you're watching this in the recorded version, leave a comment in that comment section as well. But as we get started this morning, it's a busy morning so far, as it has been kind of an interesting day yesterday. And so today's follow-up in the futures market ought to be a little bit interesting as well. So let's go ahead and get started. Excuse me, with a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or any kind of advice. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading any futures products or considering any futures strategy. Now, remember that when we talk about trading futures, futures requires futures margin. We're going to talk a little bit about that margin as we get into the discussion today, not only initial margin, but also maintenance margin. Also, remember that when we talk about something like a virtual currency future, remember that derivatives trading involves unique and significant risks. Make sure that you read the NFA Investor Advisory for futures on virtual currencies, and you read the CFTC Consumer Advisory, Understanding the Risk of Virtual Currency Trading. As we get into that discussion, we may talk about a couple of those today. Also, remember, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. It's a great learning environment. However, it is not a guarantee of future success out there in the real world. We're going to also talk a little bit about technical analysis. Technical analysis is only one way to look at the market. It is theoretical in nature. It is not guaranteed. And as such, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, last thing we're going to talk about, last two things in this context: investing involves risk, including the loss of your initial investment, including for futures products, more than your initial investment. Also, remember that stop orders in the futures market that generate a market order are not guaranteed in execution. Those orders may be worked as an exchange designated limit order, and there is the possibility that those orders may not fill, or they may fill at a different price than you expected. So be aware of those differences as we get into this discussion. So let's do this. The market's already been moving. I want to pop over here really quickly to the Thinkorswim desktop software platform. By the way, good opportunity for me to remind you to click on that subscribe button down there at the bottom of the page and be a part of the conversation and be a part of the community here. No cost to you. It's a great subscription that allows you to set alerts for new content and new archives when they drop. But we're going to take a look here really quickly at the Swiss franc. And one of the things we've noticed, and again, remember, we've had significant geopolitical risk over the last little while. We've also had some significant geopolitical change over the last little while, theoretically, right? The ceasefire issue as a potential for calming down some of that geopolitical risk, and we're certainly seeing that in the energy market. But the Swiss franc tends to be kind of that oftentimes safe haven in the event of geopolitical risk. Now, it has had kind of an interesting move. We saw this kind of inverted head and shoulders pattern. It rallied up, it's pulled back, it's rallying up once again. So in the 5-day 5-minute or in the today 5-minute chart, there does seem to be a push into the Swiss franc as potentially a safe haven. And again, when I say safe haven, that's not a guarantee of any kind of safety. It doesn't mean that, you can't experience losses in the Swiss franc, but because it's a gold-backed currency, and it tends to be kind of the fabled Swiss bank account type of perception in terms of Swiss safe haven perspective, it does tend to react bullishly when there is geopolitical risk. And we're starting to see, I think, again, a little bit of an extension of that. Despite the fact that we're seeing ceasefire agreements and so forth, there is still a little bit of volatility left. From that perspective, maybe looking at a continued move to the upside in the Swiss franc. It's been moving up today. We see a little bit of a bounce and a little bit of a pullback here. So looking for this to be potentially a bull flag type of move and a fairly small bull flag move, right? A support level here around the 1.248 level and a potential measurement target, right? Measuring this bull flag move from down here at the 1.245 area right in this part right here as a level of support would put our measurement target out here at around 1.25215 or 16 or so. So that's what we're going to look at in terms of this trade is taking that trade to the upside and getting out of the trade if it moves to the downside against us below this level of support, because in that particular case, that would be potentially an inverted, or excuse me, a head and shoulders type of pattern with the potential move back down into some of these lower support levels. So let's put this trade on and let's talk about some of the calculations here in terms of this trade. So what I'm going to do is I'm going to right click and I'm going to buy custom, in this case with an OCO bracket. Now, if we leave these as market orders, as generating market orders, especially the stop, that's going to generate an exchange designated limit order that gets worked within a protection range. All that means is the exchange is going to say, fine, we're not going to just fill this at whatever the next available price is. We're going to put a range on that. So if that next available price in a fast moving market is significantly higher or significantly lower, that orders, and it's outside of that protection range, that order may not get filled. It may get rejected. It may wait to fill. So that's something to take into consideration in a fast-moving market. Now, at the moment, it's not moving. It doesn't seem to be moving that fast. That doesn't mean that it can't, because news can always happen. So I'm going to expand this right-hand side chart for just a second. And we're going to use this as a means to determine our trade characteristics here. So we're going to trade this back up to this 1.25216 level. So that's going to be our take. If we were to call it this, we could call it a take profit level, theoretically. Not a guarantee of profit, but 1.25216 is where we're going to put that, 1.25216. That's where our take profit level is going to be. And I'm going to put that on as a good till canceled. Now we're going to have to change our time and force in our stop side to good till canceled as well. What we're going to do is we're going to look at stopping this out. I'm going to give it a little bit of room from this standpoint, right? Again, this is kind of going back to exit methodology. Connie talks about this in some of her webcasts. I know that Scott Thompson talks about this in his trading stocks webcast in terms of giving a stop level or a level of support some flexibility. So I'm going to give it all the way to the tail of this candle right here, this kind of hammer-like candle. We're going to go all the way down to that tail of that candle. We're going to put that stop order in at 1.24809. So we're going to come in here. We're going to put that stop in at 1.24809, 1.24809. And we're going to make that good till cancel. We're going to leave that as a stop. Now, we could specify that as a stop limit order. There's the potential that that could gap around that stop. I'm going to open up. Now, here's what is kind of our characteristic here. We can see where the price is now. 1.249 is where the price is. So what I'm going to do is I'm going to come in and I'm going to adjust 1.249, and we'll give it a little bit of room in terms of that limit order in terms of buying. 1.2495 is where we're going to put that limit order to get into the trade, which is a little bit higher than where the market is. We're giving it a little bit of room for us to be able to get into this trade on that market order. Now, or excuse me, on this limit order. That's not a market order, it's a limit order. So we've already specified the limit for the trade. I'm going to go ahead and fire the order off, click on that confirm and send button. We're going to read through the order. We see that our initial buying power or our initial margin requirement for this trade is $5,940 per contract. Again, transaction fees are accounted for there if we get into the trade or we get out of the trade. And we're going to go ahead and we're going to put this in our futures group, and we're going to go ahead and fire this order off. And we got filled on the order. Now it's moving to the downside. We're getting a little bit of a bounce here on this next candle, right? So let's talk about the characteristics of this trade in terms of what the potential gain and loss might be on this particular trade. And here's the reason. It's kind of bleeding below that level here. So we may see this get out pretty quickly. We may see this continue to move up to the upside. But our exit in this particular trade, so what I'm going to do is I'm going to come over here. I'm going to open up my left-hand gadget. And we're going to take a look at where our working orders are, right? So in this particular case, we've got, let's close our stocks group. Here's our /6S position. So we got into the trade at 1.2489, okay? And our stop or our exit, if we get out of the trade, we said was 1.25216. So here's what we're going to do. We're going to do 1.25216. And we're going to subtract from that our entry price in the trade, which was 1.2489. Okay. So that means that we have a move total, if that goes to our target of 0.00326. Okay, so what we're going to do is we're going to plug this back into this little calculation that I've lined out here. So our price move is 0.00326. Okay, so now from that, we need to know the number of ticks that is equivalent to. So what we do is we take that move and divide it by our tick size. So I'm going to go back to the chart. Now I could do this a couple of different ways, but I'm going to go back to the chart and I'm going to go to my other chart that I've got that grid label on. And we know that our tick size is 0.00005. So what we're going to do is we're going to take this amount, 0.00326, and we're going to divide it by 0.00005. Okay, so that is 65.2 ticks. Essentially, we're going to round 65.2 ticks. Okay, so 65.2 ticks. So that gives us a tick size or a tick move, number of ticks of 65.2 ticks. And then the next thing that we're going to do is take that 65.2 ticks and we're going to times that by our tick value. Okay, so 65.2 times our tick value of 6.25 equals a potential gain in the trade, if it goes in our direction, to our take profit of $407.50. Okay, now that's the gain side of the equation. Now, by the way, speaking of gain side of the equation, we gain so much value from your responses to our feedback survey that we want you to fill that out. Connie has graciously posted that at the top of the page. She's also reposted it in the chat. So do me a favor, take just a minute and fill out that feedback survey. Let us know what you think. Make sure that you give us some feedback. We appreciate that feedback. We read that feedback all the time. That's what helps to make these webcasts better. In fact, that's the reason why I'm currently talking about gain or loss and the risk and reward potential in a trade like this, because that's a common request that you have asked for in this webcast. So now that we know that our gain side, in this case, so our theoretical gain here is 407.50, right? That's kind of rounded. We rounded a little bit of that number. What's our potential loss in this trade? So let's go back to our monitor tab. And we said, where did we put our stop on this trade? 1.248. So we're going to do the same thing. We're going to determine where we got into the trade. And this one's going to be a little bit easier, right? So 1.2489 is where we got into the trade. That was our trade price. Minus 1.248 even equals, we got to do that. I did divide, right? 1.2489. So that's 0.0009, right? In terms of our potential loss. So let's see, that's where we were. 1.248 was our stop. It was 1.248 even, right? Let's see. Let's go view order. Whoops. 1.248, yeah, was our loss, or our stop loss in the trade. Now, that's not a guarantee of where we're going to get filled in the trade. So we take 1.24889 is where we got out of the trade. I need to put a zero in there. Minus 1.248. No, I'm doing that wrong. 1.2489 is where we got into the trade. Yeah, it's 0.0009, right? Is our potential loss in the trade. I need to be going the other way, right? 1.248 minus 1.2489. It's early for math this morning, right? So 0.0009 is the right digit, right? Yep, 0.0009. Okay. So now what we're going to do is we're going to take that 0.0009 divided by, just like we did up here, divided by our tick size, which was, if we go back to our chart, tick size is 0.00005 equals 18. Okay, so 18 ticks to the downside. I don't know why that was so hard this morning, but I get it. It's confusing and it's early. So I want to make sure that we have a clear understanding of this, right? So we're determining the number of tick moves to the upside, the number of tick moves to the downside, and then we're figuring out what the point value or the tick value equivalent of that is. So in this particular case, 18 ticks to the downside. So 65 ticks to the upside, potentially. And if it goes against us, potentially a loss of 18 ticks. 18 ticks times $6.25, 0.25 per tick is $112.05. Theoretical. Now, again, that's not absolute, because that order could fill at a different price. So 112.5. Okay. So now if we were to take what we could make divided by what we could lose in the trade, so let's do that. Let's take 407.5 divided by what we're risking in the trade, 112. Whoops. 112. Let's do the whole thing again. 407.5 divided by 112.5 equals 3.62 to 1 return to risk ratio. Yeah, early morning math is hard. Thank you for understanding, Carol. I appreciate that. That's very nice of you. Okay, so that's how we would go about calculating that discussion. Now, I chose one specifically that was kind of obscure in terms of doing the calculation, right? You have this kind of weird tick size. It becomes a little bit easier when you talk about a futures contract that has a tick size that is 0.1 or 1 as a tick size. it becomes a little bit easier to do the math. But this gives you an idea of what you can do. Now, if you want to put an Excel spreadsheet together, there are lots of them out there from third parties. I'm not going to recommend any one of those, but that's something that you could do. Is you could put together a spreadsheet with a calculation that would do that, and you could put in input tick size, tick value, and the move that the price made, and that could calculate your gain and loss for you if you wanted to create something like that. And like I said, there are some out there already that are built by third parties. In fact, some of the third-party exchanges like CME Group have those calculators available as well. All right, so let's do this. Now that we've got that move, let's see what it's doing at the moment. So it moved down. We haven't gotten kicked out yet. It's now starting to move back up a little bit, maybe gaining some strength. So we're looking for this to move up to this resistance level here on the Swiss franc. All right, so let's do this. I want to pop back grid-wise to our futures grid and kind of see what's going on here this morning around the market. So the S&P 500 grid, the futures contract here, the /ES, making a move to the upside here. Again, kind of breaking out of the range that it's been in. Yesterday was a weird day. Gap down and then a rally. And a continuation of that rally today, it seems, although coming off of the top just a little bit here this morning. And so as we pop into this discussion and see that move, we're very, very near some of these previous highs, the December, January, February highs on the futures contract, right? So ES still rocking and rolling to the upside. Doesn't mean it's without risk, but there is that potential for that move higher. The NASDAQ futures /NQ also moving higher, very near. We're taking out this high right here, the February high, very close to that December high on the NASDAQ futures. Again, a gap down and a rally and a continuation of that rally today, although coming off of a little bit of that high. On the Russell 2000, this is /RTY. This is the big contract. This morning, with a little bit of continuation, the RSI moving a little bit higher, we're approaching that 200-period moving average, in this case, that green line. And that green line has been a resistance back here in early June. It's been kind of the dividing line, right? Because we have not been back above the 200-period moving average since it broke down in late February. So this has a ways to go to get back up to some of those previous highs. But at the same time, the small caps are maybe lagging a little bit behind the other broad market indices. And one of the reasons for that, one of the reasons we might be seeing that, if we were to take a look at /10Y, the interest rate futures, in this case, the 10-year yield futures, have been moving down, but we see a little bit of a bounce, again, in this case, up off of that 200-period moving average. So that may be attenuating somewhat this upward movement in /RTY, the Russell 2000, kind of backing off a little bit. The other futures contracts that I wanted to take a look at here really quickly is we just kind of see what's going on. /CL, the crude oil contract. And this is the big crude oil contract. We've also, in this class, used /MCL, the micro crude oil contract, as an illustrative example. But starting to see that move to the downside here, breaking below that lower Fibonacci level that we had drawn in way back here, and approaching for sure, as over the course of the last 2 days, a lot of that kind of geopolitical war premium came out of this crude oil contract. But we're approaching that 50-period moving average and potentially a level of support right around this $63 a barrel range. Now, when I went to bed Sunday, I would not have guessed that in the span of 2 days, we would see a move from nearly $80 a barrel back down to the 63, 64 handle on crude oil. But stranger things certainly have happened. Stranger things are happening here in this particular case. You're also seeing this happening in /HO in heating oil, which we've looked at before. So heating oil coming down substantially, /RB, RBOB gasoline coming back down to its 50-period moving average. And we talked a little bit about this. We had actually, in fact, used this as an illustrative example post-Memorial Day when we saw that move back down to the downside. Now, that being said, in these contracts, seeing these pushes to the downside, again, this is where you have to kind of look at it from that standpoint of saying, is there an expectation of the price continuing to move to the downside? So as we look at this, we look at the RSI. One of the things that I'm noticing here is that these RSI numbers, if we take a look at /CL again as well, they're coming down hard, but they're holding some of these support levels, if you will. And RSI doesn't necessarily work in the context of levels of support and resistance the way that price action does, but it does tend to find levels relative to price action. So price on the crude contract coming down to a level of support with the RSI finding that level may be an indication that there is a potential bounce. If we saw the RSI leading to the downside, breaking through that support or breaking through that horizontal line, that might be a better indication that there is potential for further move to the downside. This is a pretty big move down. So traders may consider, as you from a technical analysis perspective, the idea of possible, kind of dead cat bounce or short covering positions, because this was a rapid move. I mean, this was a fast moving market to the downside in the crude oil contract. And it was a pretty big bearish engulfing candle. In fact, engulfing 1, 2, 3, 4, 5, 6, almost 7 days worth of move in one downward candle. And a pretty big, if we were to look at it simply from a retracement standpoint, a pretty big move to the downside as well. So there's the possibility for a bounce. We're seeing maybe a little bit of a hammer-like tail on this candle here. So there's that possibility of further upward movement in the crude oil contract. So, this is where, as we go, I'm going to pop back over to our future movers grid, and we're going to drop in here to /MCL. And this is the micro crude oil contract. Tick size is 0.01, so that's a little bit easier to calculate. The tick value is $1, so again, a little bit easier to calculate. But starting to see perhaps a little bit of a bounce today off of that support level on the /MCL contract, right? This is the micro crude contract. So what we're going to do in this case is an example is we're going to look for that possibility of a bounce. We're going to look for that bounce to maybe come back up to some of these resistance levels. So if I draw this resistance level in, say up here around that 66 mark, 66, 67 level, I'm going to round that to 67. And we can see where that 67 level is on the big longer term chart. It's going to be right about there, right? There's 67. So you can see where that I've drawn that line in here, right? So this could also very well easily, JB, be a bear flag, right? So we want to be aware of that. So we're going to look at putting in a buy stop order. If this in fact makes this move, if this is our kind of bounce pattern here, I want to see this actually in fact clearing some of these recent highs. So I'm going to look at this clearing this recent high right here at 65.69 as an entry position, right? So I want to put this in as a buy stop order. going long if it in fact breaks out of that level. If it doesn't, then I don't want to get into the trade. I could also create an order in this particular case, or a trader could put an order in to take this to the downside. But, if you think about what's going on here, we've got this kind of inclining level of support that's right in this area. Breaking through that level might be a trigger back to the downside on that bear flag idea. But we're going to look at this as a potential bullish move. So we're going to put this trade together as a possibility. I'm going to right click here at this level. Whoops, I just extended my line. That's okay. Right click, and we're going to buy custom with OCO bracket, but we're going to make this a buy stop. So we're going to change this limit type or this order type to a buy stop. Say stop, wait, don't get into the trade until the price moves above 65, we'll call it 65.70, right? That's our trigger price here. We're currently sitting at 65.35. So we're a little bit below that. So this would need to see some move to the upside. 65.70 is going to be that trigger. I'm going to leave that as a day order. Then I'm going to look at 67. We'll take 67, just round this off. 67 as my upside potential, taking that trade off. And if we do get in and then it goes back against us, I'm going to get out at 65. We'll just call it 65 for round numbers in this particular case, right? So 65.00. So now what we can do in this particular trade is we can calculate, again, what our risk and reward is in the trade. So let's go ahead and let's do that. So we know that we're going to get in this particular case. Let me adjust these a little bit so that we can see those numbers. So if we were going to get out 67 minus 65.70 equals a move of 1.3, right? So 1.3 divided by, so we're going to take our tick size, 0.01 is how many ticks? 130 ticks. So 130 ticks times the tick value of $1 means that our potential gain in this trade is theoretically $130, right? That was easy to calculate. See, I started with the hard one so that I could come into this easier one and do this a little bit easier. Now we're going to take the other side. If we were to get into the trade at 65.70 and we were to get out of the trade at 65, that's 0.70 divided by 0.01, our tick size. That's 70 ticks to the downside, okay? That's 70 ticks to the downside. And 70 ticks times $1 is loss potential $70. So if we were to take this and take 130 divided by 70, that's about a 1.8, almost a 2.0 return on risk if it goes to our potential target. Okay? So considering the correction, so this is exactly the reason. This is why we talked about this, right? Given the fact that I'm going to pop this order tool down, that this has made a big move to the downside, the CCI is still staying elevated, the MACD is still moving up a little bit, that this might be a bullish bounce and that potential for this to move back up in the short term to that range. It's been overbought, or excuse me, oversold and pushed to the downside. So the idea being that we take a little bit of that bounce up off of the support level, but we're not going to get into it until we have confirmation, right? So we're looking for the bounce, looking for the confirmation, and that's where that level is right there as a possibility. So if this goes against us and it doesn't fill, then we're not in the trade. We don't have to worry about it. So let's put this trade on just as, let's see, where we go. All right. Oh, and we need to make that, that's the reason, make that one good till canceled. Now we can confirm and send. We can read through this order, make sure that we are aware of the characteristics of this order, those transaction costs. There's our initial margin into the trade. And we're going to go ahead and we're going to fire this order off. I'm going to put this in my futures group just so that it is sitting there. And if we get that bounce, then we are ready for that bounce to potentially happen. So we're going to put that here. That's going to be sitting right here in our futures group. All right. So a couple of things that I also wanted to kind of wrap up here in this discussion. We have this long silver, small silver contract position. 5 days to go until that contract expires. It's going in our favor somewhat, although today not so much. Let's look at the chart really quickly here of /SIL. Silver and gold both have been kind of backing off a little bit. So we've got a couple of different questions that we could ask. One, do we continue to stay long silver with this little bit of a break of support and a rally back up and a little bit of a pullback? So I wanted to ask the question, if we stay long silver, if we decide that this uptrend may continue, although I'm seeing a couple of pieces of evidence that might suggest otherwise, what do we need to do as we get to the expiration? Because we see that this end contract has 5 days to go. Now, obviously, it's still the active contract. It still has the greatest amount of liquidity. If we were going to stay long this contract, what we may do at this particular point or in the next couple of days is roll this contract to the next contract, the SILQ, which is going to be the active contract shortly, and make that transition. Now, the challenge is, if we were going to roll that, one, there has to be liquidity in that forward contract in order to be able to roll. Otherwise, we may suffer from some pretty significant slippage. Number two, there's a price disparity here between the current contract and the previous contract. Look, our Swiss franc trade went again. Actually, it went in our favor, in fact. So let's take a look at that really quickly here before we wrap up that silver trade. /6S Swiss franc. So that moved definitely in our favor. And that was that trade that we were looking for, was that move back to the upside off of that move. We didn't get out, didn't get kicked out on that little dribble below. And in fact, it turned around and pushed higher and took that trade off in all of 5 or 10 minutes that we were talking about, right? As you get to that expiration date, let's go back to the trade tab for /SIL. As you get to that expiration date, which is 5 days from now, right? That contract is going to become thinner and thinner in terms of trading, because those traders who still have positions are going to be rolling those positions to the next active contract. And from that standpoint, as you get to the expiration date, this would be, again, at Charles Schwab does not allow physical settlement of physically delivered contracts. So that would be either closed or sold and delivered and settled in cash. You're not going to have a tanker truck of oil or a cattle car of cattle show up at your door. But this is something that we want to take care of probably sooner rather than later, because then you start to run into liquidity issues in the back month in terms of closing that trade down. So I wanted to demonstrate how we might go about rolling this position. So we're going to go back down here to the monitor tab, and this is the easiest way that I've found to do this, to create this rolling order, is to simply come down to the position, right click, and create a rolling order, which is selling a futures calendar spread, basically. So we're buying back the contract, or excuse me, we're selling the contract that we are long right now, and we are buying another contract out in the future. And there's a slight disparity in the price, so we're getting a little bit of a credit in terms of what we're selling the contract for and buying the new contract. Okay, so we're going to go ahead and click on confirm and send. We're going to read through this. There's going to be a transaction cost because we're closing one and we're opening another one. And I want to make sure that I'm closing and opening. I want to see that close to open. Now, there's not an additional margin requirement to move into that contract. There might be a change in the maintenance margin if for some reason the circumstances have changed for that contract, meaning the exchange or the broker has increased that maintenance margin for that trade. So I'm going to go ahead and we're going to roll this just as an example. Again, this is an illustrative and educational example so that we can see how this works. We're going to go ahead and we're going to roll this contract forward to the next contract out, which is the SILQ. We're just going to make sure that our letters and dates here, click on send. We're going to fire that order off, and we filled that order and we got 14 cents for that roll. So now we go back to the monitor tab and we can see that we've got 36 days to go until expiration. So again, it's going to depend on the liquidity, as it always does with rolling orders, the liquidity in the target that we're rolling to, whether you're rolling an option, whether you're rolling a long or short option, whether you're rolling a long or short futures position, again, that roll. So that is one consideration to think about here. Now, one other thing I wanted to look at really quickly as we wind this up, we went long volatility futures, right? And we did that a week ago, 22 days to go in the contract. We went long in the volatility futures when they were sitting at the 20.77 handle. They're starting to come back a little bit. So I wanted to look at the chart here for /VXN. That was our micro, VXM, right? Was our micro futures. Is that where we are? No, we're just long the regular futures contract, /VX. VXM is fairly thinly traded. So volatility is starting to come back again. Doesn't mean that it won't, but we've lost a little bit in this trade. It might be coming down to a little bit of a level of support. We're just going to go ahead and close this trade down before that potential for volatility to fall back to its average. Now, volatility can spike. So this is a trade that may benefit from a spike in volatility, but it certainly doesn't seem as if we were seeing much of a spike in volatility today. So I'm just going to go ahead and I'm going to close this trade down. I didn't put a stop on this. We didn't put a take profit on this trade. We simply let this trade go. And I think we may have we didn't put an alert on it. If we did put an alert on it, that alert went off and then has gone away. So we're just going to go ahead and we're going to sell these two contracts. We don't have to sell both contracts. We can sell just one. And in fact, that's what I think I'm going to do, is sell one of those contracts and leave one in place, simply in the event that volatility does maybe move higher here. But recognize that that's going to come at a cost, because that's speculative. We don't see that price moving here. So I'm going to go ahead and sell one contract. Transaction costs are there. We're going to go ahead and send that off. We close down that one contract of volatility. And Lawrence, that's probably a good enough reason to keep a long volatility position in place if Jay Powell happens to say something that sparks the market's interest and we see a big spike in volatility. So that's what we've got so far in today's discussion. We have a potential trade in our /MCL long crude oil off that little bit of a bounce. We rolled our silver position, and we adjusted by one contract our VIX position, and we got into and out of that /6S Swiss franc position that worked in our favor. And we talked a little bit about how we might calculate that risk and return. So again, remember that there's that feedback survey there. in the chat. Connie posted that up at the top of the page. I would love to have you fill out that feedback survey. Also, click on the like button. My thanks to Connie Hill for helping out. My thanks to our great production staff. And, by the way, to our great reviewers, Mindy and Nikki and everybody else that helps to make these webcasts possible for you. My thanks to all of you. I'm going to see some of you, hopefully in New York, on Saturday at our Market Drive event. Thaya, we open the doors at 8:45, so be near the doors when we get ready to open the doors, and you can get a front seat for that event. We'll see you there at the Marriott Marquis. My thanks again to everybody else. Thanks for being here. Take care, everybody. We'll see you soon. Bye-bye.